Good morning, students. Welcome back to the session on audit. Today, we'll continue with our discussion on the auditing standards. And in the last session, we started with SA 580, that was about written representations. So, we will continue with this auditing standard now. As regards SA 580, we discussed that this is one of the most relevant, most useful auditing standard. And this auditing standard is something you'll see for any entity because when it comes to a document in the form of written representation letter, it is required to be obtained by each and every auditor from the company. Now, from the company, there are various ways through which this document can be obtained, and there's also an understanding as to why this document is required to be obtained. We talked about there are few things about this document which we need to just recollect. One, that even though written representation acts as an audit evidence, this cannot be considered to be the conclusive audit evidence because it is only a supportive audit evidence. Once all other audit procedures are performed and once the auditor has drawn the conclusions, means auditor is done with everything which is required on his part, except for this written representation letter which will flow from the management to the auditor. And then the auditor obtains this letter. Means this letter has not really supported the auditor in drawing his conclusions. That is all done. Auditor has also formed his view. He has already considered as to what is going to be his opinion in terms of the financial statements. So there's nothing which this document has really impacted the auditor in terms of his final opinion. But yes, if the auditor doesn't receive this document, even after the conclusions are drawn, even after the final, in fact, even after everything is finalized by the auditor, in such a case, it may have some repercussions on the part of the auditor in terms of his final report. Such is the importance of this document. This document was all about communication of the management or those charged with governance in terms of preparation and presentation of the financial statements. You remember? So let's get back to those points. In respect of this document, the management conveys to the auditor everything in respect of preparation of the financial statements. So if we have to just understand the layout of this document, so this will come on the letterhead of the company. So this starts on that. Yeah. And then this is addressed to the auditors. So this is addressed to the auditor, means the audit firm. Okay. And then comes the content. And this content contains all the points in respect of preparation and presentation of financial statements. Everything related to this means everything on which auditor is going to comment on is something which management will also consider, because if the auditor is going to comment on the financial statements, then the management must have provided some information which the auditor would have used, and now he is commenting on that data on the basis of that information or that data which is provided by the management. Secondly, as around the audit, it's not only limited to the preparation of the financial statements, it also covers various other aspects, and that is for example, covers the internal controls. Internal controls in respect of financial reporting. So we can say ICFR, internal controls over financial reporting. Now, as around the internal controls, that is once again is the responsibility of the management. Auditor will be required to test the internal controls, whether the internal controls are operating effectively or not. But ultimately, it's the responsibility of whom? It's the responsibility of the auditor. Sorry, it's the responsibility of the management. And that's why when this written representation letter will go, management will also mention this, specify this in the rep letter about the internal controls which the management has put in place, about the internal controls which should have been implemented, about those internal controls which are operating effectively as per the assessment of the management. Okay. And if there is anything which is missing in this regard, that will again form part of the rep letter. Okay. Now, other than this, let's try to understand what are the other things which should come in the rep letter. So, a couple of these things are very, very basic for us to know. Other than this, if you remember in the previous sessions, we have discussed various points in relation to the written representation letter. And what are those points? Say if the management has engaged an expert, management would have specified how the expert has helped the management in terms of any component related to the financial statements. So that component will also come over here. Then we also discussed about any misstatement, any error, whether that error is material or not material. Now, because that error is forming part of the financial statements, so that's why when the management is taking this responsibility of the financial statement, they would also be taking the responsibility of those errors. Yeah. So some of the other things which will go into the written representation letter will include the misstatements, and these misstatements are about all those errors which have not been corrected. Because if the misstatements would have got corrected, then they will not form part of this written representation letter, because those are already corrected in the financial statements. It's all about those misstatements which have not been corrected. And this can be categorized into two parts: uncorrected misstatements which are material and uncorrected misstatements which are not material. So both are required to be covered over here. Secondly, in relation to the written representation letter, if there is any specific matter. Now, what are the specific matters? During the course of the audit, auditor may require to focus on certain items, and for which some of the procedures which are in the nature of inquiries, discussions with the senior management are significantly done. Because as around those areas or as around those items in the financial statements, some of the documents were made available to the auditor, but extensive discussion was required. because each and everything will not always have a document. A lot of audit procedures also include discussions. Discussions means verbal discussions with the client personnel, with the client management, with those charged with governance also. And wherein the documents are less than what we generally see in some other audit procedures. In such cases, at times, in addition to this written representation letter, auditor may also require specific representation. Specific representation means other than this written representation letter, auditor may require the management to put down those areas or those items on another document which is a kind of specific, very, very specific representation in relation to only that matter. Now, that is again very commonly seen in respect of various areas. Sumit has a query. Sumit is asking that written representation is the supporting document for the auditor to form his opinion. Yes, of course. It's an evidence which the auditor obtains. And because it's an evidence which the auditor obtains, so definitely this evidence is supporting the auditor to form his opinion. When I mentioned that this written representation letter is coming at the end, even when the conclusions and everything are done, that doesn't mean that this written representation letter is not important. This is definitely important. Let's try to understand. Say if we talk about procedures, yeah, so let's suppose the same stages we may cover over here. So the planning is done, execution is done. In terms of execution, various procedures have been performed. So test of control is done, test of detail is done, analytical testing is done. All these things have been done. Okay, all these things have been done. Now, on the basis of all of these procedures, conclusions have been drawn. And once the conclusions are drawn, auditor will get into the reporting mode. Reporting means coming to an end and expressing an opinion. It's all about forming a view. Comes to the opinion. Now, if we talk about all of these three stages other than the reporting, in these stages, this letter is not coming to the auditor. Correct? Auditor is performing all the procedures other than obtaining the written representation letter. So when would this letter come to the auditor? This would come at the time of reporting. So when the auditor will give his opinion to the management, that is the time when the auditor will also take a written representation letter from the auditor. Yeah. So that's why we can say that even though this is coming at the end, means after all other audit procedures are performed, still this is not something which is not helping the auditor on forming his view, on expressing his opinion, or obtaining certain inputs out of this document which is helping on his opinion. It is definitely there. Okay. In fact, if we look at the written representation letter, it is obtained from the management on the date when the audit report is issued. In fact, all of these three generally go hand in hand. What are those 3 points? Signing of financial statements means the date on which the financial statements get signed. Auditor's report means the date on which the auditor's report is issued, the date on which the auditor's report is signed. Number 3, management representation letter. Generally, we will see that all these three documents are obtained on the same date. All these three. Okay. They are obtained on the same date. And let's try to understand the purpose of this as to why this should be done on the same date or near around same date. If you look at the auditor's report will draw a line. So it's based on a cutoff. Means as at a particular date, everything has been looked at by the auditor. Okay, so let me just put down this cutoff. Say this was 31st of March 2020 and on say 31st of August 2020 audit got completed, and this is the date when the management plans to sign the financial statements. Let's suppose on this date financial statements will be signed. Okay. Now, because the management or the company will sign the financial statements on this date, so if we look at the requirements of subsequent events, auditor would have performed all his procedures up to this date, or auditor should have performed all his procedures up to this date to ensure that any subsequent event which impacts the financial statements as at 31st March 2020 would have been taken care of by him. Now, considering that situation of 31st August 2020, what will the auditor want to do? Sign the auditor's report on this date. So that the cutoff which he has drawn is helping him in terms of taking care of all of his audit procedures, because up to this cutoff everything has been done by him. So this is the date when the financial statements are getting signed, and same date auditor is also issuing the auditor's report, signing the auditor's report. Okay. Now let's assume if the auditor signs the auditor's report, let's suppose on say 30th of September. Let's suppose on this date audit report is signed. Now what will be the consequence of this? The consequence will be that for next 1 month, means for this period, auditor would have to plan another procedure, or may have to plan some more audit procedures, and which may have an impact on the financial statements also, because of which The financial statements may have to change, and that's why if they get signed over here, they may have to change. Correct? So that's why generally you will see both of them getting signed on the same date. Number one. Number two, now when it comes to the financial statements which are getting signed on a particular day, on that very day, management should give the representation. Why? Because if they are signing on a particular day, then up to that date, any event which would have arisen, even if that arises after 31st of March, but if that event may have a bearing on the financial statements as at 31st March 2020 would get covered. Let's suppose if the management representation letter is given on this date, say this is 15th of May. See, management is saying we have to share this document. So why to wait till the end? We are sharing this document on this date. Now on this date, when the financial statements are not finalized, everything is not concluded on the part of the management. So what's the point? Is there any point in getting into these documents? Not really. Okay. So this document will not really help the management as well as the auditor in terms of its relevance on this date. Its relevance will always arise when this is provided to the auditor on the date when he is signing the auditor's report. So that's why it should come over here. Secondly, because it's a necessity. Correct? So it's not something which is a wish of the auditor. It's a necessity which has to be obtained by the auditor. It's helping the auditor in forming his audit opinion. So that's why, can the auditor really delay this document after his auditor's report? No. Because on the date of the auditor's report, this document should be available with the auditor. Because if this document is not available with the auditor, this audit evidence was missing, then how will the auditor substantiate that he has got this document up to the date of the auditor's report later on to, let's suppose, any reviewer, etc.? It will not be possible, and that is not something which the auditor can do. He has to ensure that all the audit evidences which he would have obtained were obtained by him up to the date when the auditor's report gets signed. Clear? So that is the reason why you will see all of these things getting signed on a single date. Okay, clear around the signing, etc., in respect of written representation letter? Yeah, all of you clear on this? So let's move further on to this written representation letter. We can just look at some points from this presentation for the purposes of our discussion. Now, if you read this part, which is coming from the auditing standard, it says the date of the written representations shall be as near as practicable to, but not after the date of the auditor's report on the financial statements. The written representations shall be for all the financial statements and periods referred to in the auditor's report. Of course, because this rep letter has to cover each and everything which is flowing into the financial statements. All right. Now, as regards the form of the written representations, let's understand. The written representations shall be in the form of a letter addressed to the auditor. If the law or regulation requires management to make written public statements, means something which is going in the public domain about its responsibilities, and the auditor determines that such statements provide some or all of the written representations required by this essay, the relevant matters covered by such statements need not be included in the written representation letter of the auditor, because that anyways is available in the public domain now, from which anybody can pick up, including the auditor. Okay. Now we may have a question that, let's suppose management refuses to provide this document. Okay, management refuses to provide this document. Let's suppose management says, no, I will not share the written representation letter. Why? Because everything is done. So management is telling the auditor that you have performed each and every procedure. Every information which you asked for was provided by us. Then now, what's the need? What's the need for this written representation letter? And this is something which we discussed in the last session, that even though everything has been shared by the management, every data has flown to the auditor from the management, still there is a need for this written representation letter, and it's a mandate which comes from the requirement of auditing standards. So if the management does not provide one or more of the requested written representation letters, written representations, means if let's suppose a rep letter is not provided at all, or if the rep letter is provided but the management doesn't include everything which should be mentioned on the rep letter, then what would the auditor do? First of all, auditor would discuss with the management as to what's the problem, what's the concern in sharing this information with the auditor. Because there should not really be any concern. It may be a communication gap. Yeah, so first of all, this discussion has to happen between these two parties, auditor and the management, so that this confusion, if any, is gone. And on the basis of which, then it can be taken up further. Number one, auditor would also reevaluate the integrity of the management and evaluate the effect of this on the reliability of the representations. Then the management will refuse to provide a representation. This may really put a question mark on their integrity, because as I told you last time, that in terms of getting the information from the management is one thing, having discussions with them, having inquiries and getting their responses verbally is one thing, but when it comes to put down anything in writing, it becomes very important, or you can say, it's something which is serious. And if the management is not really interested in providing this rep letter, which should actually not be a problem to them. Why? Because they have explained everything, they have provided information around everything. Then this may really put a question mark on their integrity. Means anything which they don't want to provide in writing now, was that really correct or not? Or what has been the real problem in not providing that representation? Is there anything which is missing, or which is being hidden, or is there anything which the management is just trying to hide from the auditor in respect of the preparation, or in respect of anything in relation to the financial reporting? So this may create doubts in the mind of the auditor, and this is something which will put a question mark on the integrity of the management, and because of which auditor may require to plan certain additional procedures, because this is not something which you'll see in the normal course. Okay, yeah. Next, as around the integrity when it comes to the management, auditor would also discuss all of such matters with those charged with governance. Because over and above management, it's also the audit committee, or you can say board of directors, with whom auditor would have had communications. In fact, this is one area which is mandatory on the part of the auditor to communicate to those charged with governance. And once this communication is done, auditor would also want to share with them as to this is something which has been not shared by them. So this matter will be taken up by the auditor with those charged with governance. Correct? Yeah. Now, when the auditor discusses all of these matters, but let's suppose ultimately this document is not something which he would have received, then what's the course of action? In such a case, the auditor may have to look at the reporting implications of not receiving this audit evidence. Now, there is something which is missing. Now, because of this audit evidence, if there is anything which the auditor believes may get impacted in terms of the financial statements, then the auditor will also have to consider its impact on the auditor's report, and that's why he may have to look at the possible effect of any of these areas in terms of giving his final opinion. Okay, clear? Moving further, the auditor shall disclaim an opinion on the financial statements if the auditor concludes there is sufficient doubt about integrity of the management, or management does not provide written representations as per the requirements of this auditing standard. Now, it may be a very, very serious matter, because when it comes to the disclaimer, though we have not really talked about it, when we move further, so we'll talk about disclaimers, etc. also. Disclaimer, you can say, is a kind of a situation wherein auditor would communicate to the users of the financial statements that audit could not get completed due to lack of information. So that's why I'm saying this can be a very, very serious matter. And generally, you will not see this happening. This will be rare. This will be rare. Yeah. Because management will never do that. They will not share the rep letter at all. Yes, it's true that they may want to cut down on certain areas in terms of their rep letter, in terms of giving the representations. But rep letter is something which the management would always give to the auditor if the auditor would request for that document. Okay. Now, as around this management representation letter, even though we are currently talking in the context of financial statements, this is not really limited to financial statements. Let's suppose the auditor is doing tax audit. Okay, tax audit is another thing we'll cover later on. There again, auditor is required to obtain this rep letter from the company. Let's suppose auditor is doing GST audit. There again, auditor is required to obtain this written representation letter. Let's suppose auditor has done some certification for the company, any sort of certification. There again, auditor is required to obtain the written representation letter from the company. That means for each and everything which the auditor would do for the company, for each and everything, in terms of the attestation work. Attestation means which is something which will require the work wherein the opinion is given. There it becomes the responsibility of the auditor to obtain a written representation letter from the management, and which the management will definitely share, or management will have to share. Okay. However, practically what you see is that this written representation letter is not obtained by the auditors. Practically, you will not see the auditors obtaining the written representation letters. In fact, many cases you will see that the awareness about this fact that the audit requires, or this project requires that the auditor should obtain a written representation letter from the management is not there. So that's why, even though this is most relevant, this is something which is required everywhere, you see this rep letter being taken by the auditor from the management is something which doesn't happen in most of the cases. Okay, yeah. So that's why utmost care has to be taken, and this is something which you cannot ignore at all. Okay, clear? Yeah. Now, at times we may have a situation wherein some of the areas may be disputed by the management. Management may not want to give some of these things in the form of an representation, etc. Therein, the auditor may have discussions with the management and may just try to convey to them as to why all of these documents are important and what is the relevance of all of these documents on the audit opinion, so that they get convinced and they understand the requirements. And anyways, this is a necessity as per this auditing standard, and which management cannot ignore. But till the time this is not clearly communicated by the auditor to the management, they may not really want to give this. Okay. So let's look at one example now, through which we'll just try to understand some of the things in relation to this auditing standard. Let's say, if we talk about a company ABC Limited, for which audit is completed. Okay, audit for this company is completed. Now, in respect of this company, this was a listed company. Couple of matters have been reported as scam. So, two matters have been reported as scam. Yeah, and there was one uncorrected misstatement. Uncorrected misstatement. One. This was not material. Okay. There was one uncorrected misstatement which was not material. And other than that, all the audit procedures are performed by the auditor, and auditor is convinced has wrong everything in the financial statements, and the audit report will have clean opinion, means no modification. Audit report will not have any modification. So it's the clean opinion. Now, in this situation, auditor has requested the management to provide a written representation letter covering all of these areas. But the management has refused. And the management doesn't really want to cover all of these areas on the written representation letter. So let's try to think of the situations which may arise, and you can then let me know as per you which all situations can be accepted by the auditor. And before I get on to these options, I'll just quickly answer the query of Jay. Jay is asking, so the audit procedures need to be applied till the date of auditor's report and not just till 31st of March. Yes, of course. I think you missed out on subsequent events. Just go back to that auditing standard also. It requires everything to be covered till the time auditor's report is signed off. Then Naga has a query. Naga is saying, is there any amendment with respect to SAI? I think whatever is the amendment, etc., is something which will be covering over here. So don't worry about it. Then I think a couple of queries are there in respect of the recorded classes and the PPT, for which I will request the admin team to look into it and get back to all of you. Okay, so now in relation to this, first option could be the one wherein we may say that CAM or the matters which are getting covered under CAM should be there on the written representation letter, or you can just say, for your better understanding, under CAM, the auditor has covered revenue recognition. Means auditor is calling this to be a significant matter and specifying this as his key audit matter in the auditor's report. Secondly, auditor is talking about inventory valuation. Okay, so these two matters are the one which the auditor is considering to be important, significant, and that's why he wants to put that in the auditor's report, and on which he wants these matters to be specified in the written representation letter. Secondly, as around the uncorrected misstatement, this may not come. If the management is not convinced, this may not come. Okay, so this is first option, but all other areas, in relation to financial reporting should come on the record. Okay, so option number one. Option number B, that CAM may or may not come, means CAM means these two areas, may or may not come. Uncorrected misstatement we have discussed, this should come even though this is not material, and all other areas are of course required. Option number B, and all of you can just start sharing your responses about these options. Option number C, let me just put down everything. CAM should come, uncorrected misstatement should come, all other areas should also be there in the rep letter. So C includes everything, and D says CAM may not come, uncorrected misstatement may not come, but other areas are a must. Other areas are a must. So if they get excluded, then of course it's an important thing. Okay. So can you just get on to these options now one by one and start sharing your responses on this quickly. Quickly, can you just start sharing your responses one by one? Okay, so Naga and Chavi are going with option number C. They are going with option number C. So let's try to understand about option number C first of all. Now, as around option number C, it says CAM should be there. Now, CAM basically covers two areas. What are those two areas? Revenue recognition and inventory valuation. If we talk about preparation of the financial statements or in the financial statements, these two areas happen to be the most important areas anyways. And if CAM would be there, CAM would always be covering the significant areas. CAM would not be talking about any of the irrelevant area or something which will not be a significant one. It will be all about significant areas in the financial statements. Correct? Yeah. So that's why in relation to financial statements, representation on these two areas is important. And if this is forming part of CAM, of course, these two also require representation, which is not in the nature of CAM, but in the nature of how the management has got into the financial reporting in respect of these two areas. So that means this is a must. And the moment we say this is a must, option number D and option number B go off. Correct? Yeah. Number 2, uncorrected misstatements. Now, on this uncorrected misstatement, there was another auditing standard. Uncorrected misstatement is something which is there in the financial statement. So when the management has prepared the financial statements, those have been prepared with the uncorrected misstatements. So if they are commenting on the preparation, definitely they will have to comment on this. Yeah, they will have to comment on this because this is what they have done in the financial statement. So that's why this is again a must. This cannot be ignored. Correct? And the moment we say it's a must, option number A goes off. And what are we left with? We are left with option number C. And let's try to understand this third point. All other areas. All other area means anything which is related to the financial reporting. For example, accrual of expenses. For example, controls around the financial reporting framework. For example, capitalization if the company have had. For example, policies of the company in relation to any of the items of the financial statements. Disclosures in the financial statements. Each and everything will be moving into this. Correct? So that's why third area is also importantly required. And this third area, in fact, doesn't seem to be disputed by the auditor or by the management also. So anyways, on this, every option had a clarity, but we also need to understand conceptually whether that was really required or not. Correct? Yeah. Okay. We can pick up another example now on the written representation letter. See, for example, management prepared financial statements for the year ended 1920 and finalized everything by say 29th of April 2020. Or let me just make it instead of April, let me just make it July. Okay, 29th of July 2020. Audit procedures, because the audit was performed up to 31st of August 2020. Okay. Board of Directors approved the financial statements on say 1st of September 2020. So this is the date when the board approved everything. Audit report is signed on 1st of September 2020. Okay. Yeah. So this is the date on the audit report is signed off. Rep letter. Now a question mark is around the dates of the rep letter, for which we can pick up some options now. Can we say that the rep letter be of date 1st of August? Number 2, 1st of September. Number 3 is, let's suppose it can be say 2nd of September. And number 4, we can say it's about 30th of August 2020. Which one out of these you will consider as the best option? Naga has a query in the meantime. Naga is saying a written representation for all other matters relating to financial statements means what are the contents? Naga, it's about everything which is moving into the financial statements. Means anything which has been used for preparation of the financial statements. I gave you a few examples. Accounting policy in relation to PP, in relation to expenses, in relation to various disclosures. So everything which is being used by the management for preparation of financial statements. Okay, now coming to these options. Which one out of these 4 you will consider as the best option on the in respect of requirement related to the written representation letter? Quickly, any thoughts from your side on this? Jay is saying it should be option number B. So let's try to understand about this. Now the standard says that rep letter should not be the one which comes after the date of the auditor's report. So that means 2nd September is not possible. And the standard further says it should be as near as practicable to the auditor's report. And which out of this is as near as practicable or the closest to the auditor's report? Of course, it's 1st of September, the date when the auditor's report is signed. So that's why if the auditor would have options, then the auditor would always want to go with the date on which he is signing the financial statements, because that's the date on which he should ideally be obtaining the auditor's report. And same is the response from Naga on this. Clear? All of you? Yeah? Okay, great. So with this, we come to an end to our discussion on SA 580 with this. Now we'll move on to next standard. SA 600. Using the work of another auditor. And before we start with this, let me just see if any of your queries remain. Naga is saying, sir, is there any format of written representation in SA 580? I think yes, it's there. And the format is also the one which I shared with you. And this is very simple. On the letterhead of the company, written representation letter has to be given. It will be addressed to the auditor. Then this will have the subject that it's about the management representation letter in relation to what? In relation to financial statements, in relation to say Form 3CD, or in relation to the certificate or the information which the auditor would have certified, or say any practitioner would have certified. So this is in relation to the format, and then of course comes the content. Content means various information on which the management will start commenting. And at the end, this has to be signed. And it's expected to be signed by one of the directors of the company generally. Jay is asking, sir, the corrected misstatements will also form part of MRL? Not really. Not really. If the management wants to give that, they can definitely give it. But if the misstatements are corrected, then these will not form part of management representation letter, because these are already gone into the financial statements and those are already corrected. Something which is uncorrected is specifically required to be given by the management, because that stays uncorrected in the financial statements. But as around the corrected misstatements, there could be so many. Yes, that's why there's no relevance of having that in writing, that these were the misstatements which got corrected. Okay. Now we can move further. Yeah. Now moving on to SA 600. This essay talks about the communication channel between two auditors. principal auditor and the component auditor. And let's try to first of all understand about the principal auditor, about the component auditor, to understand some of these requirements. Yeah. So let's move on to the definition first of all. Who is the principal auditor? Principal auditor means the auditor with the responsibility for reporting on the financial information of an entity. When the financial information includes financial information of one or more components audited by another auditor. So that means we can say it's about a group wherein financial statements of group are audited by one auditor, and in respect of various companies in the group, auditors happen to be different. Just give me 1 minute. So what we can do is we can look at one chart to understand about this requirement in a better manner. Say for example, if we have this company X Limited, and let's suppose below X there are 3 companies: Y Limited, YZ Private Limited, XYZ Limited. Okay, and let's suppose below Y there are again 3 companies: TY, SY, let's suppose RY. Correct? Yeah. So this is the structure. So for example, now this structure requires consolidated financial statements to be prepared. Why? Because X has got control over this, and I'm just hoping that you remember control criteria, etc., which you would have covered under Ind AS or even under Indian GAAP. Now, because X has got control over this and over these companies eventually, so that's why financial statements of group will be prepared. Financial statements of group will be prepared. So one is of course the standalone financial statements of X Limited, which will be prepared. But along with standalone financial statements, group financial statements will also be prepared, and which would also be required to be audited. Okay, those will also be required to be audited. Now, standalone financial statements of all of these entities will also be prepared. Standalone. Similarly, standalone financial statements of these entities will also be prepared. Yeah. Standalone will come for this. Standalone will come for this. and consolidated financial statements for this group will also be prepared, but I'm not getting into that consolidation. Now, all of these standalone financial statements would also be required to be audited, correct? And these standalone financial statements will actually move to this company, which will prepare consolidated financial statements basis all of these standalone financial statements. Yeah, this is all about consolidation procedure. Okay, so when we say financial statements of group, basically we are commenting about consolidating financial statements. Okay. Now, in relation to all of these aspects which have been covered over here, we are talking about a situation wherein the auditor for this company is, let's suppose, auditor 1. Auditor for this company is auditor 1. Now, X Limited will prepare its standalone financial statements. Is that correct? X Limited will prepare its standalone financial statements in addition to consolidated financial statements. And both these financial statements will be audited by whom? Auditor 1. So X Limited has engaged Auditor 1 for audit of this as well as this. Okay. But at times, a situation may be possible wherein X Limited does not engage Auditor 1 for audit of these entities. So if you look at all of these entities, you may be thinking that, sir, these entities are controlled by X Limited. So if X Limited is engaging Auditor 1 for its own financial statements, the same auditor may be engaged for these entities also. Of course, yes. So that is one possibility. But it may be possible that instead of engaging Auditor 1 on all of these entities, another auditor is planned. Say Auditor 2 is engaged over here. We have Auditor 3 over here. We have, let's suppose, Auditor 4 over here. Correct? So we can see different auditors are involved in the audit of the financial statements. And similarly, let's suppose we have Auditor 5 for these three. Let's suppose we have Auditor 5 for these three. For this one, and for this one. Okay. Now, let's think about the situation of audit and let's try to look at some of the practical problems and how this audit will be done practically. First of all the auditors would audit the standalone financial statements of these companies or the respective companies. Correct? One auditor may have multiple companies to handle, or one auditor may have only one company to handle. We are not getting into it. We're just saying that first of all, they will audit the standalone financial statements of the company. Okay. When it comes to Auditor 1, after this audit of standalone financial statements, auditor will get into audit of CFS. And for the purposes of audit of CFS, this Auditor 1 would require audited financial statements of all of these companies. All of these companies are technically termed as components of X Limited in the consolidated financial statements of X Limited. So Y Limited will be called as one component. YZ Limited will be called as one component. So all of these are what? They are nothing but the components of the group. And who is the parent? X is the parent. Okay. So that's why all of these auditors, auditor 2, auditor 3, auditor 4, auditor 5, they will always be called as auditors of the components, or you can say component auditor. So who are they? They are the component auditor. Okay. So this is a component auditor. This is also a component auditor. This is also a component auditor. And this is also a component auditor. And auditor 1 is whom? He is the auditor of the parent. And that's why he is called as principal auditor. Or the auditor of the parent. Clear about the terms which are used and what is the situation that we have been discussing over here? All of you. In case you have any questions, you may let me know. So now I'll get back to those definitions on the presentation itself so that you can now understand their meanings. So I'll just read this definition of principal auditor again. Principal auditor means the auditor with the responsibility for reporting on financial information of an entity when the financial information means this one includes information of one or more components. These are the components audited by another auditor. These are the other auditors. Okay. Who are these other auditors? They are termed as component auditors. Other auditor means an auditor other than principal auditor, means 2, 3, 4, with responsibility for reporting on financial information of a component which is included in. So these informations, standalone financial statements of Y Limited is included in CFS of X Limited. So which is included in the financial information audited by principal auditor, means CFS. So CFS is the one which is audited by principal auditor, and financial statements of Y Limited are flowing to CFS. So that's why auditor of Y will be called as other auditor, or you can say the component auditor. Clear? And what's the component? We have understood. Component could be a division, a branch of a company, subsidiary, joint venture, associate. It can be anything which is moving to get consolidated in the consolidated financial statements, and for which auditor is different than the principal auditor. Clear on the meanings, the terms which are attached? Yeah. Ambika is saying, sir, the branch is not covered here. Of course, the branch is also covered here. It can be anything. See, currently in my example, I have not taken the branch. But let's suppose instead of Y Limited, it's a branch. So this can also get covered. Okay. Yeah. Or if you just want to increase this, I can also bring in one branch over here. So say this company X Limited has a branch and I'll make it a foreign branch. And this foreign branch, let's suppose, is also altered by another order. So let's suppose this is order 6. Okay. So it can be anything. Correct? Yeah. And all of these companies are not necessarily required to be in the same country in which X Limited is there. They could also be based in other countries. Say, for example, if we have to make it, say, all of these companies are in India. Let's suppose this is India, and all of these companies are also in India except RY, which let's suppose is in Germany. Okay, and this foreign branch, let's suppose, is in US. Clear? Now I've covered each and every type of situation over here. But idea is for you to understand the perspective as to what is getting covered and what is not really getting covered. Clear on this now? Yeah. Now we will move on to audit procedures. We will move on to the requirements of this auditing standard. Because so far, all of these things which we have discussed, they all come down to the understanding as to what situation is covered under this auditing standard. Now, because the auditor is different in the financial information audit of components, so that's why when the audit of CFS will be performed, so let's think about the situation. See, the CFS would include various information. It will include Y, it will include YZ, it will include XYZ, and so on. And all of their information will be included. And because because auditor 1 will have to express his opinion on this consolidated financial statements. That's why auditor 1 would need two things. One, the financial information of all the components. Because on the financial information, he may have to perform the audit procedures. So he'll need that. And this is received by him. Auditor 1 has received financial information of all these components. From whom? From X Limited. Because X Limited will collect all of these informations and share to Auditor 1. If there is anything in terms of the information which Auditor 1 would require, that will always be collected by X Limited and provided to Auditor 1. If Auditor 1 wants to reach out to any of the components directly, Auditor 1 can do that. If the Auditor 1 wants to check any information of any of these components directly, Auditor 1 can do that. Why? Because he is responsible for audit of financial statements, which includes all of these informations. Correct? But there is some practical aspect which is involved over here. Theoretically, we can say that Auditor 1 can go to each and every component component, look at their information and get this audited. But do you think practically this will be possible, or this will be easy both on the part of the auditor as well as on the part of the management? There are two challenges. One, if you look at the management has already got the audit done for the financial statements of their components. So they may think that one auditor has already audited our financial statements, and now another auditor is asking for the audit of same financial statements, which may be a duplication. Correct? Number one. Number two, as around this auditor number one, this auditor may also have problems. Why? Because something which is already audited, he will have to audit again. And even though this is not audited by auditor one, this is audited by somebody else, he will have to audit that again. And wherein he is not involved in the audit of the financial statements. Yes. So that's why, to avoid that, this standard requires division of responsibility, which is extremely important aspect of this standard. This standard requires division of responsibility. Now, what do you mean by division of responsibility? This standard says that the component auditor would audit the component and would share the audited financial information to the parent auditor or the principal auditor. Okay. Principal auditor will not be involved in the audit of the component. And when the principal auditor will be giving his opinion on the consolidated financial statements, principal auditor will specify in the auditor's report itself that in relation to these components, principal auditor has not done the audit. Instead, they have been audited by other auditors, and who would have provided either clean opinion or say modified opinion, whatever it is. So whatever is provided by the component auditors, that is something which will be taken by the principal auditor and would be included in his report on the consolidated financial statement. So that's how the work would be divided between the principal auditor and component auditors. Now it can be one component auditor or it can be multiple component auditors. This is all about division of responsibility. However, even if we talk about division of responsibility, or even if we say that principal auditor has been relying on the work of the other auditors. This basically, if he is specifying in his audit report that these components are audited by another auditors which he has not audited, so what is he doing? He is actually relying on the work of all of these auditors. Now, when it comes to standalone financial statements, if you remember, we discussed that financial statements audit is the responsibility of the auditor in totality. Means there is no aspect of the financial statements which the auditor can say he has not audited and on which he has relied on somebody else. Not possible in respect of standalone financial statements. But here it happens to be slightly different. And here component auditor is the one who is fully responsible for the component, and principal auditor is the one who is not fully responsible for consolidated financial statements or its audit. He is actually placing reliance on the work of all of these auditors. Okay. But even after the reliance, or even though this auditing standard requires the principal auditor to place reliance on the work of these auditors, still there are few areas which this auditing standard requires the principal auditor to take care before finalizing its audit report on the consolidated financial statements. Okay, yeah. So now what we will do is we will get on to those areas. We will try to understand what are those areas which the principal auditor needs to take care while finalizing his audit report. Point number one. Even though principal auditor will not be auditing the components, still he will share with the component auditors any significant risk which would be assessed by the principal auditor in relation to all of these components. Any significant areas which principal auditor believes is significant in relation to any of these components will be shared by the principal auditor to the component auditor, and this is something which we call as planning. During the stage of planning, principal auditor would plan certain procedures, would do the risk assessment of the group as a whole. And while doing the risk assessment of the group as a whole, principal auditor would identify certain items having significant risks, or we can say certain components having certain items as significant risks, and on which principal auditor may require specific procedures to be performed by the auditor of that component. Even if principal auditor is not auditing that, he will require the component auditor to perform those specific procedures, which the component auditor will have to do and then report to the principal auditor. Okay, so this is one, and it's a kind of now communication between principal auditor and the component auditor. Secondly, materiality. Second very important aspect of the audit of consolidated financial statements happens to be the materiality. Now, when it comes to financial statements audit on a standalone level, materiality for X limited, Y limited could be different, YZ private limited could be different, but it may happen that in the group's financial statements, these components are considered to be very insignificant. Why? Because the group is very big, X limited is very big, and these are only small components. And therefore, the materiality criteria in relation to the group as a whole is assessed by whom? It's assessed by auditor number one. Because he is looking at the picture of the group. He is not really concerned about each and every component. If there is any component which is insignificant, then that is again something which will be assessed by auditor one, and that's why a group materiality will be determined by auditor one. Okay. When the auditor one would determine the group materiality, then on the basis of the group materiality, auditor one would get into two situations. Situation number one. Group auditor may say that Y Limited is a very small company in terms of its size as compared to the group. So within the group, or you can say in the CFS, Y Limited is very small. If you look at the revenues of Y Limited, if you look at the profitability, if you look at the total assets, okay, considering various parameters, Y Limited is considered to be very insignificant, or we can say insignificant. And the significant or insignificant is again assessed from the perspective of materiality. Correct? Looking at the materiality, all of these things will have to be assessed. Yeah. Now, considering that situation, considering the materiality and all, in the first situation, the principal auditor may decide that the audit of Y Limited is not required to be performed. Why? Because this is insignificant. So that's why no separate audit of Y Limited will be performed. Principal auditor may decide to perform only analytical procedures on Y Limited on his own, or maybe through another auditor, maybe auditor number 2. Okay, this is situation number 1. And I'm not moving on to situation number 2 because there can be a question on this stage that, sir, how is this possible that audit of Y Limited will not be performed? Because Y Limited is a company, and for every company, audit is a must. So is there any option that the audit is not performed? So now we are looking at a completely different situation. See, when it comes to Y Limited, it's required to be audited statutorily. Means the Companies Act requires that this company has to be audited necessarily. But that is the audit of its standalone financial statements. Now we are looking at its consolidation in CFS. So for the purposes of its consolidation, will the audit be required or not? Because let's suppose this company follows 31st of March, for which its audit is done and that is not changed. But let's suppose CFS are prepared as at 31st of December. Now we are looking at the audit of this Y Limited for the purposes of consolidation. So that's why for the purposes of consolidation, we are checking whether this is required to be audited or not. And these two dates may be same. And wherein the audit of Y Limited may already have been performed, which is okay. So we are saying that such situations will have to be analyzed by the principal auditor, whether this Y Limited is significant to the group or not. If that is insignificant to the group, Y Limited may, auditor 1 may cut down on the scope in relation to Y Limited when it comes to audit of consolidated financial statements. Okay, and that limited scope in relation to Y Limited may again be decided by the management tax unit. Who will perform that? Auditor 1 or auditor 2. Okay. So this was situation number 1. Another situation which may arise on the basis of materiality is that audit is required to be performed. Okay, so Y Limited is considered to be significant, for which audit is required to be performed. Now, when auditor number 2 will perform the audit of Y Limited, once again, two options could be there. Either auditor 2 will determine his own materiality for audit of Y Limited, which would be done in case of statutory audit. Therein, Y Limited will determine his own materiality. But When it comes to consolidated financial statements and when it comes to audit of Y Limited for the purposes of consolidation only, therein it's the principal auditor who will communicate the materiality amount. It's the principal auditor. Okay. It's the principal auditor who will communicate the materiality to component auditor. And using such materiality, component auditor will perform the audit of Y Limited. So please try to understand. Now basically we have drifted away from statutory audit. So for the purposes of this consolidation, we are not looking at the statutory audit of all of these components. No. We are basically looking at a kind of audit of these components which is required only for the purposes of consolidation in consolidated financial statements. Correct? Yeah. So that's why we can say that planning of this group audit will be done by the principal auditor, who will do the risk assessment, who will look at the significant areas, who will look at the significant areas for which audit procedures will be performed by the component auditor, and who will also look at the scope of these components, whether these components are required to be audited or not, and in case these are required to be audited or whatever limited work is required to be performed on them, what is the materiality level or what is the materiality that the component auditors will have to use or the principal auditor will have to use. And that materiality level will also be communicated by the principal auditor to the component auditor. Okay, clear? Now I've received some queries from Nagasai and Ambika. Let me just look at those queries. Nagasai is saying that, sir, due to lack of time, principal auditor may not be able to complete the audit procedures with respect to the components. So what is the auditor's approach in near the last date for filing the audit report? See, there cannot be any such excuse that because of lack of time, audit may not be completed. No, that is not acceptable. Huh? So this is not possible. Ambika is then asking, so does the principal auditor need to specify in the engagement letter the fact that he will be using the work of the component auditors? Of course, yes. So everything which is going to be there in the auditor's report will also be forming part of the scope of the engagement, scope of the principal auditor. Then Nagasai is asking, sir, in which essay risk assessment is defined and what does it mean? So there is another auditing standard which deals with risk assessment, and I'm not sure as to why you are asking its meaning, because so much time we have already spent on the risk assessment. Risk assessment very simply means to check what are the risks which are possible. So many times in our sessions so far, we have discussed about controls. Yes or no? Controls of the management. And who is responsible for those controls? It's the management. Why are the controls put in place? To mitigate certain risks. Because if any control is required to be put in place, why is that control required? There could be some risk. Yes or no? There could be some risk. To mitigate that risk, control is put in place. Yeah. Now, considering the fact that there are various risks which exist in the organization for which controls are put in place, what is the auditor required to do? Auditor is also required to ensure whether that risk assessment was done by the management or not. And how will the auditor do that? Auditor will also assess all of those risks. And auditor will also be looking at the controls which are there to address all of those risks. Okay, clear? Nagasai is then asking, is there any chance of materiality is determined by principal auditor for components is less than the materiality determined by the components? See, generally what you see is that the materiality which the principal auditor would determine for the component would be higher than what the component would determine for its own component generally. Okay, and that's why whenever principal auditor would make a communication to the component auditor, principal auditor would say that for the purposes of audit of the component, either you use X materiality or any materiality lower than this amount, which is determined by yourself. Principal auditor would never share any materiality which is lower than the amount which is determined by the component auditor, because determination of materiality by the component auditor would be done later on. First of all, it's the principal auditor who is doing this work, so he is starting off. Okay, yeah. So practically, I have never seen this happening. Practically, if you look at the components, they generally receive component the materiality amount which is significantly higher. Okay. Secondly, let's also try to understand about this entire process. See, basically, audit is nothing but a project. Yes or no? Audit is a kind of project. So this project is required to be executed. And for a project, team is mandatory. Because without a team, no project can be executed. And same is the case of audit. And by chance, this group audit requires a large team. Yeah. And we can see there are so many teams which are involved in this. Teams not only of the management, but also of the auditors. And for any project, a very, very important thing which is required happens to be the coordination. Coordination amongst the teams. Because if the coordination will not be there, then the execution of project may not really be proper. Yeah. Project requires a very, very important thing, and that is about coordination. And that's why within this process, coordination between all of these teams is very important, for which a clear communication channel should be established. And who is sitting at the top? It's the principal auditor who is sitting at the top. So that's why it's very, very important for this principal auditor to set up all of these communication channels and to ensure that the coordination amongst all of these component auditors with the group auditor or with the principal auditors happens to be in place throughout the course of the audit. And for doing this, a set of instructions. So these are technically called as group referral instructions. A set of instructions is sent by the principal auditor to each and every component auditor at the beginning of the audit, wherein everything about the component, about the risk assessment of the component, about the significant areas in relation to the component, about the materiality to be used in relation to the component, about any other matters which were of significance, and about any of the matters which were considered to be significant for the purposes of audit in the previous years about the component, are communicated by the principal auditor to the component auditor. And that is a must that always flows. And therein, a time plan is also shared. A communication channel is also shared. That means on what stage component auditor will share the deliverables to the principal auditor, and at what time that information will be required to be given. because audit has to be a time bound process. It cannot be just running into multiple days, or it cannot just running into a period of time which is not really fixed. Yeah. And the communication channel means how would the component auditor communicate with the group auditor. That communication channel is also established. That is always specified in the instructions which are sent by the principal auditor to the component auditor. Okay, clear on this? So we are not yet done, but I think what we can do now is we can just quickly take a break of 10 minutes, and after the break we will continue with our discussion on this auditing standard. Please remember that this auditing standard is considered to be very, very important, because as around the consolidation, which is now a must for all the companies that you get to see. Earlier this happened to be a sort of voluntary requirement, now this is mandatory. And in respect of listed companies particularly, these requirements are significant. Yeah, so this standard is very, very important, practically as well as from the examination point of view. Okay, so what we'll do is we'll continue in respect of our discussion on this auditing standard after this break, and we'll also look at some practical examples around this auditing standard after the break. All right, yeah. So let's take a break, and in the meantime, if you have any queries, just feel free to send your queries. So let's move on to the break now. Hi, welcome back. Now, as around this component audit, let's get into some more points which are important from the perspective of the principal auditor. One, planning is all done. Now comes the execution. And we understand that the communication channel and the coordination is all going fine. If you look at the component auditor is required to focus on the areas which have been specified by the principal auditor in terms of his referral instructions to the component auditor. Plus, he will also be required to independently audit the financial statements of these components. Why? Because even though principal auditor has done some risk assessment of a particular component, even though principal auditor has communicated the materiality level, still the audit will be the responsibility of which auditor? Auditor number 2, auditor number 3, auditor number 4 in respect of their entities. So that's why it cannot be ignored that all of these procedures are driven by the principal auditor in respect of certain areas, but the independence of the audit in relation to all of these components will have to be maintained by all of these auditors, and they will also be required to follow all the audit procedures. They will follow all the requirements of the essays in relation to audit of these components, even if that audit is required only for the purposes of consolidated financial statements. Okay, so this is one. Secondly, in relation to the component audit, certain areas may always get missed. And let's try to understand those areas. Yeah. So I'm just removing this component for the time being. Now let's try to understand about those areas and which therefore will be the responsibility of the principal auditor. So are those really missed, or do we say those are the responsibility of the principal auditor himself? Now what are those areas? See, when it comes to the component audit, and even though for the component auditor, even if for the component auditor happens to be a different auditor, still, if the principal auditor feels the need, he may get into that particular area of that component directly. Means YZ Limited is audited by Auditor 3, and the audit report has also been shared by Auditor 3 to Auditor 1, and everything was absolutely fine. Auditor 3 also performed the specified procedures which Auditor 1 requested Auditor 3 to do, and everything was all fine. Still, if the Auditor 1 is not convinced, or Auditor 1 feels there is a need to perform some more procedures in respect of this particular component, Auditor 1 may require Auditor 3 to do that part again, or maybe to perform additional procedures on that, or Auditor 1, if he feels the need, may get in touch with this management and perform those procedures on those areas directly. So that is also one of the options which is possible. Okay. Number 2, as around some of the items which will flow from all of these components to the parent, Let's look at some areas. RY, we understand, is a company based in Germany. Okay. And this has produced its financial statements. Financial statements were prepared in the gap of this country. Those were prepared in the gap of this country. And these were also audited by the auditor. Who was the auditor? Auditor number 5 is the auditor for this company. Audit report is all clean, so there is absolutely no problem in this. Secondly, we understand that for the purposes of group, financial year was 31st of March. But this component follows 31st December as the financial year. So they don't have the financial information up to 31st of March. Okay, and that's why what this auditor has done, the management prepared financial statements as at 31st December, which have been sent by the auditor to the parent. Now, if you look at the consolidated financial statements, they are prepared as per Ind AS. And there could be certain differences between German GAAP and Ind AS. Now, who will take care of this? Because when it comes to the consolidated financial statements, they have to be prepared in the same gap. The accounting policies of the parent and the component should be same, but which may not be the case. There could be differences in that. Now, who will have this responsibility? Now, this responsibility is that of the management, because preparation of financial statements is the responsibility of the management, correct? But management of RBI has not done this work. Why? Because the corporate team, the parent, required RY to only send the German GAAP financial statements in German currency as at 31st December for the purposes of consolidation. And any changes from German GAAP to Ind AS are done by whom? Management of X Limited. Any adjustments which are required in relation to this gap of 3 months in the reporting period are being made by whom? X Limited's management. Okay. So something which the RBI has not done, will Auditor 5 be able to audit that? No. So now all of these adjustments are directly flowing into the consolidated financial statements. Correct? All of these adjustments are directly flowing into the consolidated financial statements. But are those adjustments audited by any person? Auditor 5 has not audited that, for sure. So that's why it will be the responsibility of whom? It's the Auditor 1. It's the principal auditor who will be responsible for audit of these adjustments. On this part, principal 1 cannot say that these were the financial statements of RY which were audited by Auditor 5 and on which he has been placing reliance. It's correct up to a stage, but after that stage, when the numbers which were reported by IY got changed to something else, and which have been adjusted by the management of the corporate or the group company, then adjustments which are unaudited, those are required to be audited by the principal auditor. That division of responsibility will require this part to be covered by the principal auditor. And principal auditor cannot pass on this task to RY, because it will not be possible for RY to do this. It will be possible only on the part of principal auditor to do this. However, for the purposes of audit of these adjustments, which are flowing into the consolidated financial statements, principal auditor may seek some help, may seek some clarifications, may seek some information from the auditor of RY, which the auditor of RY will have to provide, which is okay. Okay. Clear on this? Similarly, we can look at the case of this foreign branch. Now this foreign branch, let's suppose is audited by auditor 6. Now similarly, what is this auditor going to report on? He will audit the foreign branch and the financials of this branch will be passed on to the parent. There again, similar sort of problems may arise. The gap in which branch has prepared its financial statements could be different from the one used for consolidation. The reporting period could be different. And that's why all of these adjustments in relation to branch will again be the responsibility of whom? The audit of those adjustments will be the responsibility of, therefore, the principal auditor, which he cannot avoid. He will have to audit that. Okay, clear on this? Clear on this part? Yeah. Another point which requires consideration. And you will be thinking, sir, there are so many points are not coming to an end. This standard is actually very, very important and very, very interesting. You will just get into the details of this auditing standard. Another aspect which this standard requires is about the reporting by the component auditor. Now let's try to understand those reporting requirements. Now it is not necessary that the component auditor will give the clean opinion. Many a times there could be modifications which the component auditor may put. Many a times there could be emphasis of matter which the component auditor may put in his auditor's report, which is flowing to the parent auditor. Or many a times there could be certain uncorrected misstatements which are below materiality, which are shared by the component auditor to the parent auditor. So I'm looking at those situations now. Okay, I'm just clearing this part to just put down those points over here. 1. There could be modifications. Number 2, there could be uncorrected misstatements and which are immaterial. Immaterial, but you can say are of a reasonable amount. Now, if you look at the uncorrected misstatements first of all, because those were immaterial, so that's why component auditor would provide a clean opinion. Yeah. But if you look at the console level, at the consolidated level, it may happen that all these component auditors have shared their uncorrected misstatements. They have shared their uncorrected misstatements. And at the group level, this X Limited also has got some uncorrected misstatements. Now, when it comes to the assessment of uncorrected misstatements, whether those are crossing the materiality or not, how do we look at it? If we go back to our discussion, we look at it on the basis of accumulated impact of those uncorrected misstatements. So that's why all of these uncorrected misstatements are very important for the parent auditor, because eventually parent auditor may get into a situation when the areas to which all of these uncorrected misstatements pertain, even though they happen to be immaterial at the component level, but at the group level, its impact may go beyond the materiality, and which the parent auditor may want to therefore get adjusted in the consolidated financial statements, or at times even though those remain below materiality, even at the group level, but still the management of the group may not want to keep that as uncorrected in the consolidated financial statements. That's why either the management may instruct these components to pass these adjustment entries in their standalone financial statements and report back to the parent, or the parent may itself pass these adjustment entries in the consolidated financial statements. Okay, this is one. Ambika, I will come to your query. So this is one. Number two, let's suppose if there is any modification, there is a qualification which has been put by the component auditor in his report. There is any emphasis of matter which is put by the auditor in his report. Or let's suppose there is a significant finding. There is any significant finding which the component auditor has identified and reported to the parent, but the impact of this significant finding was not there as per the assessment of the pay component auditor, and because of which component auditor gave a clean opinion. Now, in respect of these two items, once again, even though these are coming from the audit itself by another auditor, component auditor would have applied his professional judgment, would have used his experience, would have used his knowledge to conclude on these areas. Still, it's the parent auditor who would also want to get into the analysis of these findings. Because it may happen that the component auditor believes that this was a significant finding, but conclusion was still to give the clean opinion, which may not be the opinion of the parent auditor. And that's why parent auditor and the component auditor may require another rounds of discussion in respect of such matters amongst themselves, amongst the management of the component and the management of the parent company. And these things are very commonly seen in case of audits. Particularly some of the components which are significant, therein these things become very, very important. Because there will be a lot of areas during the course of audit which the component auditor would have considered as significant but still closed. Closed means has not really qualified the opinion, and because the parent auditor, because of the fact that he has not done the audit of the components so much detail in which component auditor has done the audit, so that's why parent auditor may require deliberations in respect of those matters. And that's why whenever the parent auditor sends across the set of instructions to the component auditor to report back to the parent auditor, there also happens to be a document around these significant findings of the component auditor, on which component auditor is required to explain in detail what were those findings, what were the audit procedures performed by the component auditor in respect of those findings, and what were the conclusions and the basis of conclusions by the component auditor in respect of those findings, so that these can be analyzed in detail by the principal auditor. Because please understand the problem of the principal auditor. He doesn't have so much clarity which component auditor has got, because he's just looking at the company, which is the parent. He's not really looking at all of these components. So about the understanding of all of these components, about the areas or about the procedures of all of these components, he may not have much visibility. And to put it very, very simply, we can say it's the component auditors who are playing the role of group auditor in respect of component audit. Because why is the component audit getting conducted? For the purposes of CFS. And because The group auditor is not doing it himself. That's why what has he done? In a way, he has assigned this to somebody else. Okay. So basically, all of these component auditors are sitting into the shoes of group auditor only as far as this component is concerned or its audit is concerned. Clear on this? Yeah. I'll come to this point number 1 on modifications also. Ambika has a query. Ambika is saying, sir, let's suppose the group accounting policy is not followed by RY Germany. So this is what I clarified, Ambika. Let's suppose the group accounting policy is not followed by RY because they have followed their German way. Then who will make these adjustments of alignment of accounting policies? The parent. Two ways are possible. Maybe they go back to RY and ask them to make these adjustments in their financial statements. If that is possible, if that will be done, then auditor of RY, auditor 5, will audit that and send it again back to the parent, or parent may decide to pass these adjustments in the CFS directly. In which case, audit of those adjustments will be done not by auditor 5, but by the principal auditor. Okay, clear? Okay, so now moving on to the next point, and that is about modifications. Now, this is again very common in respect of the components and particularly the significant components. What if the component auditor has given a modification in his report and over which parent auditor has got a different view? Because if the parent auditor will also have the same view which the component auditor will have, then what will the parent auditor do? Parent auditor would carry that modification to his audit report as it is. Why? Because he is just simply relying on the work of the principal auditor. Okay, so this is one. But let's suppose component auditor has included a modification, but as per the view of the principal auditor, that modification should not have been given. Now, two options are available, or you can say two situations are possible. It's not really the option. Basically, two situations are possible. First scenario will require a discussion or a deliberation between the principal auditor, component management, and the group management. All these four parties will have a deliberation in respect of that modification. In fact, this is generally done beforehand, before the final reporting is done by the component auditor, because this communication channel keeps going on. Generally, this is what the good corporates require, and this is generally what you get to see in case of group audits, wherein the communication channel happens to be proper. Otherwise, after the report is sent out, then things may not become very, very clear in terms of how the things can then be improved upon. In this first scenario, after the deliberations, if the auditor is still not convinced if the principal auditor is still not convinced with the view of the parent auditor, then what would he do? Then he will look at the materiality of the group. Because for the component, the materiality level will always be lower than what the group materiality is. Because for the purposes of reporting in the consolidated financial statements, what is relevant? Group materiality. Jay is asking about example of modification. Say there is a qualification. Say there is a qualification in the auditor's report in respect of Y Limited. That's an example of modification. Now, if at the group level, the modification which the component auditor has given is not crossing the materiality, is below materiality, then on the basis of the materiality, if the principal auditor wants, he can drop that qualification. He can drop that qualification. Why? Because he needs to comment on the truth and fairness of the consolidated financial statements. And he has to express his opinion whether the consolidated financial statements are materially misstated or not. So that means he has got the materiality. And his materiality amount, because it was higher than what the component auditor had, that's why he got this additional cushion and he could drop that qualification if he wants that. So it's not something he would always want to drop it. It's dependent on his judgment. Another situation is the one wherein the principal auditor is not convinced with the view of the component auditor and the materiality is not allowing the principal auditor to drop that qualification. In such a situation, principal auditor will not be able to drop it till the time it's removed by the component auditor. Why? Because if the component auditor has taken a view and it's the audit which component auditor has done and on which principal auditor is relying on. He is specifying in his audit report that he is relying on the opinion of this auditor. That's why in such a situation, it will not be possible for the principal auditor to drop that qualification because there will not be any basis for the principal auditor to drop that, because at one place he is saying he is relying on this auditor, and at the second place, if he drops this qualification, then this seems to be a contradictory situation. Correct? Yes or no? Understood? Yeah. So that's the impact. Okay. And all of these things that we have discussed so far in relation to this component audit or this parent audit, as far as consolidated financial statements are concerned, these are very, very practical, and these are something which you very, very commonly see in the audit of the consolidated financial statements. All right. Yeah. So what we can do now is, other than all of these situations that we have discussed, I'll just try to sort of create certain situations, and we'll just try to put all of these situations in that example, and let's see how do we really take care of those situations. Okay. So now I'll move on to some examples around this. Let's suppose there's a group having say 4 components: A, B, C, D. Okay, PQR is the parent. Yeah. Say A is subsidiary, B is associate, D is JV, sorry, C is JV, and let's suppose D is foreign subsidiary in a foreign company. Okay, yeah. If we look at the companies, B and C are significant. They are material to the group. In terms of revenue, in terms of profits, etc., these are significant to the group. But subsidiary is not significant. And it's only a shell company. Shell company means this company has just got established. There is no business, nothing, etc. in this. So this is completely immaterial as far as consolidated financial statements are concerned. Now, for the purposes of audit of CFS, we can say we have this principal auditor. And here we say that the auditor for B and C is also the principal auditor. Okay. So if we say principal auditor is A1, then over here B, sorry, let's suppose this is, say, it's P1. Principal auditor is P1. Then for B, auditor is again who? P1. For C, it's again who? P2. Sorry, it's P1. So principal auditor is also involved in the audit of these two. For subsidiary in India, it's P2, and for subsidiary outside India, P3 has been appointed. So they are the auditors. Correct? Now we have got few situations which we can consider. Situation number 1. And all of you can just keep thinking about all of these situations and try to analyze all of these options one by one. Situation number 1. SA 600 will not apply over here. SA 600 will not apply. Why? Because if we look at the two main components of the group, they are audited by the principal auditor himself. And the other two entities in the group which are required to be forming part of CFS, those are insignificant. So that's why this auditing standard should not apply. Number 1. Option number 1. Option number B. SA 600 will apply. Okay. So we are starting with application of SA 600. But requirements of SA 600 will not be fully implemented. Means a diluted version of SA 600 will be applied. In a way, so what's the requirement? Because the parent auditor is himself auditing the associate and GUD. That's why nothing in relation to SA 600 becomes relevant to this. As regards A, whether P2 conducts its audit or not on time as per the requirements of instructions, it doesn't matter. That's why no instructions, etc. will be rolled out. No instructions, etc. is required. No communication, coordination, etc. is required. Okay. In relation to P2. And in relation to P3, because it's a foreign company, so that's why complete set of instructions, etc. will be rolled out. Instructions, etc. all in normal course. All are done as in the normal cores are done. Okay, option number B. Option number C. Option number C also starts with an understanding that SA 600 will apply. But instructions, etc., will not go to P3. Instructions, etc., will all go to P2. Okay, yeah. Option number D. Option number D. Option number D requires that because these are associates and JVs. So once again in option number D, we are saying that because these are JVs and associates, that's why nothing really is relevant in relation to these two entities. So that means they are scoped out of they are not relevant from the perspective of SA 600. Because for them, alignment of accounting policy may not be possible as per the requirements of Ind AS for associates. For JVs, again, the entity PQR may not be able to establish a clear control, means the unilateral control. So that's why it may become a challenge over here. But of course, for this subsidiary, including this foreign subsidiary one, the relevance of SA is there. But considering that these two are insignificant, the standard itself says drop them. Okay, yeah. So standard says drop them. Subsidiaries are dropped. So even though SA will apply, but considering associates and JVs, those will be scoped out. Number two, these subsidiaries, those will not be scoped out. Those will be there in the scope, but these are so insignificant. These are not considered to be relevant at all. Okay, yeah. So these are the options that we have in place. So let's discuss about all of these options one by one. Which one out of these options you believe is the correct one and why? So I'll also discuss these situations one by one. Okay, so now shall I move on to these options one by one? Talking about option number A, which says that because these two are audited by the principal auditor himself, and because these two are insignificant, that's why SA will not apply. Will that be the correct answer? No. SA will apply. SA will apply. Why? Because even if associates and JVs are considered, they fall within the purview of SA. And the moment we say that, option number D also goes off. Correct? Option number D also goes off. Because that is also based on an understanding that because of associates and JVs, SA will not apply, or at least to that part SA will not apply, which is not correct. So SA will apply to that part as well. Okay. Now moving on to next option. It says for P2, an entity which is not significant at the group level, the requirements of SA may be diluted. What are those requirements? No instructions, no communication, etc. is required. But at the same time, for P3, which is in fact even less significant, even lesser significant than P2, for that it requires all these procedures to be carried out, which appears to be contradictory. Just because of the fact that P3 is based out of say US, this requires all the instructions, everything to be put, which may not be right. Because if we are ignoring all of these things for this subsidiary, then this subsidiary is only created. It's only came into existence. So it's a paper company. Yeah. So just got incorporated and there's no business at all in this company. Yeah. So can this option be considered to be right? No. So what is the option that we are left with? Option number C. And let's try to also understand this option. It says for P3 instruction, even if those are not sent out, it's okay. Why? Because we understand there's no business in this company. It's a newly incorporated company. It just got incorporated. Except for the share capital, there's nothing in this company. So what is there to audit in this company? Nothing. In fact, the principal auditor itself can ask for this information from the parent and can get this done. So this is okay. As regards P2, even if this is not significant, but still, if the parent auditor wants, he can set up the scope of this entity as audit or maybe lesser than audit, whatever it is, for which all of the requirements of SA will have to be fulfilled. So that's why for P2, it's again correct to say that it should be done. Clear on this, all of you? Yeah. So we can pick up another example now. Small one, I'll just try to pick up a small example. Ambika is asking, sir, SA will apply for P3 also, but in option C it is not considered. See, that depends on the scoping. And if the parent auditor is considering the scoping that P3 is something which is immaterial, there's nothing in this, there's no transaction at all. As I told you that it's a newly incorporated company, it's only the share capital which has been inducted. And that's it, there's nothing in this company. So that's why what is really the need or to perform any procedure on this. And even if that is there, it's the principal auditor who can do on his own by obtaining that information from the parents management or maybe from the components management. And that's why for P3, if that is dropped, it's acceptable. Okay, so let's look at an example. Say ABC has got few companies. Say G1 in Germany, J1 in Japan. Let me just call it as J in Japan. Say another company we can say I in India. And let's suppose we can pick up another branch, okay, FB, which is a foreign branch, which let's suppose is in UK. Okay, so this is the structure. This company follows Ind AS, has got 31st March as the year end. For this company, it's 31st of December. Follows German GAAP. This company follows 31st of December. Follows Japanese GAAP. This company follows 31st of March, follows Indian GAAP, but is now under Ind AS because of this being a subsidiary. And this foreign branch follows the 1st of March and follows IFRS. It's not the UK GAAP they follow IFRS. Okay. So this is the understanding. Now, we are required to look at the requirements of SA 600 in this situation. We can look at some options now. Option number A. Sorry, before this, I'll just put down some information over here. Auditor of ABC is P1. Auditor of G is G1. It's J1. It's I1. And it's FB1. Okay, so these are the auditors of these entities respectively. Now, considering Ind AS, the consolidation will be required, and which will require consolidation of all of these companies. So that's why first option is that all of these entities will have to send their financial information as per Ind AS. Otherwise, P1 will have to qualify at the console level. Option number B, all these entities will have to send their financial information as per local GAAP. Local GAAP means GAAP of those countries. Okay. We will audit the adjustments. Or we can say audit the GAAP adjustments. But may ignore period differences. Okay, but the principal auditor may ignore any differences which arise due to differences in the period. This is 31st March, 31st December, 31st December. And these two are 31st March. And the reason for ignoring these differences are, this is not significant at the parent level. This is not significant at the parent level. Okay. Option number C. Because these two are not significant at the parent level. So that's why for G and J, no gap adjustments are required. And for I, gap adjustments are not applicable. For FB, gap adjustments would be audited by P1. Option number C. Yeah, option number C. Manish, I'll have to come back to your query slightly later, please. Maybe towards the end of the session. Option number D. Now what can be option number D over here? We can say that foreign branch and the Indian entity so we can say G and J, no gap adjustment required. For I, gap adjustment audited by P1 again. Only the gap adjustments are audited by P1 again. Why? Because principal auditor may not be sure about the application of Ind AS on this entity. Otherwise, it's all okay, huh? For FB, gap adjustments will be audited by P1. Yeah, so C and D are largely same except for the fact that for I it's not applicable in option number C, and in option number D we are saying that because it's Ind AS which is relatively new to India, so that's why these gap adjustments should really be reviewed or audited by the principal auditor also, even though this has been audited by the component auditor. Okay, yeah. So now moving on to all of these options one by one. Yeah, quickly. Moving on to all of these options one by one. Option number 1. Excuse me, just give me 1 minute. In the meantime, you can just go through these options. Okay, coming back to option number A. Option number A says that because these are the entities outside India, so that's why they can just share their financial information as per Ind AS. Why? Because they will need to make their adjustments as per Ind AS. So the responsibility for preparation of the financial statements as per Ind AS has been passed on to whom? The components itself, for all. And if this is not done, then what will happen? Parent will qualify this. So the parent auditor will qualify the report. So that means even if the component auditor doesn't provide this, and the principal or the parent's management get this adjusted in the consolidated financial statements, parent auditor will not accept it. Can this option be considered to be all right? No, we cannot consider this option to be all right. So what do we call this option as? Wrong. So this option goes off. Okay, yeah. Any options from your side also? I'm just waiting for your options also. Moving on to option number B. It says they need to send their financial statements as per local GAAP. Means they don't need to make the adjustments. At least this part seems to be okay. P will audit the GAAP adjustments, which is again okay. Why? Because parent will make those adjustments in the consolidated financial statement. So P will have to audit, P1 will have to audit. But as regards any differences which may arise due to the time period from 31st of December to 31st of March, this parent auditor need not check. Why? Because these components are insignificant. Even though the components are insignificant, still there could be certain significant adjustments in relation to these components during these 3 months. Yes or no? And which may not be known to the auditor. So can the auditor just ignore those impacts? Can the auditor say that I'll not consider those points? Not possible. Okay, so that's why this option also goes off. Option number C. Option number C says for G and J, no gap adjustments are required. Why? Because these gap adjustments will be done by the parent. So which is again okay. Yeah. And even if no gap adjustments are made, this can still be considered to be okay. Why? Because these are insignificant entities. So the gap adjustments will not result in any significant impact. Number 2, for Indian entity, which is preparing its financial statements as per Ind AS, will the gap adjustments be really relevant? Will that really be relevant? Not at all. So this is not applicable. And for the foreign subsidiary, because that is significant, so their gap adjustments can also be significant, and that's why those will be required either by the foreign branch or by the parent, but that will have to be audited by the parent auditor in case that is passed by the parent's management. So this seems to be the right option. The only difference in option number D as compared to option number C was the fact that gap adjustments are required to be rechecked by the parent auditor in relation to this Indian entity, which is wrong. Why? Because there are no gap adjustments for the Indian entity. This Indian entity is preparing its financial statements as per Ind AS only. So if they are preparing as per Ind AS, can there be any gap adjustment at all? No. There can definitely be errors, but that is something different. That is not a gap adjustment. Okay. If this entity is preparing their financial statements primarily as per Ind AS, there is no gap adjustment, so it cannot be considered to be correct. So that's why, what will be the right option in this scenario? Right option will be option number C. Okay, clear on this? Yeah, very good. So now what I'll do is I'll just come back to some of your queries. I think I've received few queries today as around the recorded version.
I think for this I need to tell them.
Yes.
That
so
there
I think
technical glitches.
I'm done with this. In fact, a couple of queries I'll just specify. One is on the recorded classes. And
I think majority of the students are asking about that only.
Yes, sure.
And actually this is technical glitch. So live coaching classes are not streaming on ICAI CA channel. So they can watch live and recorded session at live.ici.org/BOS/VCC/. We really regret the inconvenience. Just because of technical glitch, they need to go to VCC.
Okay. So can we also specify the timeline, Karuna, by when this technical glitch will be resolved?
Actually, we need to discuss with technical team, and hopefully it will be resolved soon. But until the time, they need to watch from that place. And one more thing, students are asking whether we are covering amendments. So amendments, of course, there are in many chapters, but the topics, auditing standards, I already mentioned in our inaugural session only that auditing standards carries majority of weightage, 25% to 40% weightage is there. So they need to understand the auditing standard carefully, because in paper, generally question is being asked, how auditor will deal, how auditor will report, and there are standards, law, all provisions are in evaluation and synthesis type or application and analysis based questions are there. So they need to understand standards very carefully. These are very important standard, and please students note this is for old and new syllabus both, and we are not covering only bare standard. Here your lecture is application and analysis based. Achal is giving a situation based question to you where you need to apply, and you need to apply your brain ki how we will be analyzing the situation, how we will be applying the standards, how we will visualize and click the correct answer, because in paper it's not straightforward question. You will be having application and analysis based question, integrated case scenario based question. So these standards based lecture are very, very important for you, because these are basic base for you. And after this we will be covering LODR and other chapters which are amendment based, because there are lot many amendments are there. So just after this we will be having audit report series, and then we will be covering amendment part also. But these are very important, and you need to listen and understand carefully, because it's having vast weightage in your examination. And Achal is very nicely explaining you how to apply, how to analyze.
I think another query has come in, Karuna, that recorded lectures are not even available in the site we just mentioned. So I think it will be good if you can just share some link, etc., with the students, wherein they can just access the lectures.
Yeah, I've already mentioned that due to technical glitch, these classes are not streaming on ICAI YouTube channel, and link for that live and recorded session is live.ici.org/bos/vcc/. So they can go to that link and they can see the live and recorded sessions. It's available there, and hopefully it will be resolved. Technical glitch will also be resolved soon.
I think you can just repeat once. Students, you can just note down this this link once again.
live.ici.org/bos/vcc/. Okay,
great. Ambika has also shared this link in the message just now. Okay.
So don't worry about this recorded session. You just go to that link and you can see there. Yeah, and you can ask a query. You can see recorded lecture as well as live lectures.
Correct. And even if this is missing right now, later on when this technical glitch gets resolved, all the recorded sessions will come over there?
Yeah.
Okay. So it's only a time gap?
Yeah.
Okay, great. Sure.
So students, you need to read the standards carefully, and Achal is giving you very much practical views, and you need to practice, you need to analyze the situation and apply the relevant standards, and accordingly having practice of answering the questions. Thank you, Achal. I think I have all the queries.
Yeah, sure. So I think we can just conclude this session. Thanks to all of you, and thanks Karuna for sharing the insights. Thanks so much. And in the next session, we'll start with another auditing standard. Thanks so much.